What's better than earning money from a 9-to-5 job? It's earning money while you sleep, which is made possible if you start investing. You're listening to the Real Estate Investing Demystified with your very own dynamic duo, Ava Benisaki and August Biniaz. Tune in as we discuss everything real estate, both on the passive and active sides. We feature life-changing stories of today's real estate leaders that will help build your own roadmap to success. This is a show that will lead you to a diversified portfolio, a much bigger revenue, and a next-level venture that brings you a smooth cash flow. Let's get this episode started. Welcome back to the Real Estate Investing Demystified show. We've done over 200 episodes now, August.
Absolutely, yeah. We're super excited about this episode.
Yeah, our guests keep getting better and better, and we have an economist on the show today.
Yes, well, not just any economist, but somebody who understands the real estate space very well. Somebody that we follow. We follow his a lot of the content that he's on and a lot of his literature. So we're excited to have Peter Linneman on our show.
Yeah, absolutely. So let's get into a little bit about Peter, you guys. Peter is the founding principal of Linneman Associates, a leading real estate advisory firm for more than 40 years. Okay, he has advised leading corporations and served on over 20 public and private boards, including serving as chairman of the Rockefeller Center Properties. He has published over 100 scholarly articles, 8 editions of the acclaimed book, Real Estate Finance and Investments, Risk and Opportunities. And he is also the co-creator of the popular and highly regarded Real Estate Finance and Investment Certification course. So Peter is the author of the Linneman Letter, a quarterly report which every investment firm should be subscribed to. So we're going to leave more about Peter in the show notes, so we find out more about him there. But welcome to the show, Peter. Thanks so much for being here with us today.
It's my pleasure. Thank you for having me.
Thank you. Great. Yeah, let's start the show off, Peter, with, we human beings, we seem to have short memories. For real estate investors, that's even amplified. But, the old adage where, history doesn't repeat, but it rhymes, it is really true in the real estate space. And we're excited about your predictions when it comes to 2024 and beyond in real estate. But we want to take a trip back in the memory lane and get your perspective on past economic cycles that we've been through. Maybe not us, but yourself and other investors who've been through over the last time. And Ava and I were doing some research before the show, and we realized the number of recessions that have come through just over the last 45 years that we researched. I mean, this has gone on for well over 100 years, but just over the last 45 years, I mean, you got, starting 1969, 1970s, guns and butter recession, 73, 75, oil embargo recession, 1980, Iran revolution recession, 1990, 1991 Gulf War, 2001 dot-com, 2008 GFC, Great Financial Crisis, 2020 COVID. Please tell us any memorable stories that you can share from these recessions that have come and gone, any survivor stories, any distress stories you could share, please.
Well, I think I go back to the 69, but even more so the 73 to 75 was in my adult memory. Look, they all have, let me do it differently. I would describe the US economy as the following. It is a font of entrepreneurship. It's a font of creativity. It has great, relatively stable political, legal infrastructure, has great financial infrastructure that keeps getting better. And therefore it grows, except when it doesn't. And simply stated, and this is overly simple, it kind of grows about 8 out of every 9 years. Unfortunately, it's not that regular. Why does it occasionally not grow? One of two things happens. Either we were so happy at how it was growing, we get out ahead of ourselves. So you can go back in time, and we bought all the automobiles we needed for like 1980, 1979, but we also bought all the automobiles we needed for 1980 that year. Well, then 1980 came and we didn't need automobiles, we'd already bought them. And so you go, okay, well, that slows it down, right? I'm being overly simplistic, but housing, the so-called housing bubble, we got so enamored that in 4 years, we built 2.2 million more homes than we had people to fill them in 4 years. So then came the next year, we already had the homes. We already had the homes the year after that. We already had the homes the year after that. And so that shut down a big part of the economy until it got back to something normal. So one source is overexuberance. We just get too exuberant, and we're enjoying not just the normal times, but the good times, and we convince ourselves that the unsustainable is sustainable. And then you find out it's not, and things taper down, but when they taper down, they revert. That's one of the reasons. And the other tends to be with major regulatory governmental interventions. And the only reason I say government is, who else can have a big enough impact? You can't, I can't. I can do dumb things, but not big enough to stop the economy. You can do dumb things, but not big enough to stop the economy. The government can do things that can stop the economy. And the most recent example was dramatic, which is, we're going to shut the economy down, or about a third of the economy down. I mean, just a little under 4 years ago, right? The government decided, I'm not saying right or wrong, they decided you can't shop in malls. You go, what? Well, that's going to have an effect. You only can go to work if you're, quote, an essential worker. I mean, that's going to shut an economy down. And I'm taking that as an extreme example. Less extreme examples are the Fed raises the interest rate, quote, too high. Most of the economy doesn't care. Most of the economy doesn't care. A lot of people never borrow. A lot of businesses never borrow. They don't care. But some do. And that slows them down, and they raise it too high. And you get it. So, and I only say again, because only the government can affect that big a footprint. And we just lived it with the shutdown. You could argue, was the shutdown smart or dumb? That's not the point, but it created a recession because you shut a third or more of the economy down. Those are the two reasons. We either get over exuberant, and then we have to kind of sit on the sidelines a little bit with part of the economy, or it's government overreach. And those are kind of what? Exuberance is overbuilt in human beings, and government overreaction is kind of built into human beings. And so it's going to happen.
Yes. Yeah. So Peter, what causes recessions? Is it just the behavior of the economy, which we can't control? Or is there a remedy for these swings? Or do we just have to learn to live with them?
Exuberance, government initiatives, what you just explained. But yeah, is there a way to be able to control these swings?
Not really. Not, I mean, in my view, I mean, lots of millions of books have been written about that. I don't think you're going to change a fundamental exuberance in people. I don't think you're going to change government not making mistakes. I mean, give me a break. They're just human beings in those jobs. Of course.
How about AI? How about if we get AI involved, and then AI can see historically what has caused it, and they can advise
and maybe help with some of the economic cycle predictions, advise central banks on the interest rate increasing or decreasing.
How much to increase, how much to decrease, how much to keep it up, how much to keep it down?
But in a fantasy world, perhaps. In a real world, I just don't think so. There are 335 million human beings in this system. There are God knows how many businesses. There are God knows how many government offices. I don't even quite know what AI would do. If you think about AI in the way you're describing it, it would be central planning. Well, we saw how well central planning worked with human intelligence. I'm not sure it's going to work. I mean, we saw it in country after country central planning. So I'm not sure AI is the answer to that. What can you do about it? I think you can learn to live with it. Don't panic, first of all. The world isn't coming to an end. Every time it goes down, somebody says the world's coming to an end, including the recent one, right? Remember, people were saying no one is ever going to shop at a store again. They're all going to do online. Well, that was stupid. No one's ever going to work at a hotel again. But people were saying that. Understand, things tend to revert. Not 100%, they tend to revert. Don't panic. And that's why I say you get back to it's going to be a rough next year when a recession starts. focus on it's going to be a good 8 years after it. How do I make it through the rough period? I live in the Northeast. If a storm comes, it's not the end of the world unless I do something really stupid, like go out in the blizzard with inappropriate clothing, right? Or drive in dangerous conditions. You adjust. That's the same way with recession. Tighten your belt a little bit. Don't take that vacation that year. Kind of cut back, be prepared, and be prepared before it happens. I think it's more about being prepared for what human existence is, in a way.
Got it.
Awesome.
So just learn to live with it, I guess.
Just learn to live with it, yes. And Peter, from all the recessions, which happened since the late 1800s, why did the 2008 recession get the notorious title, the Great Financial Crisis?
Well, it's interesting because it was the deepest since the Great Depression, but it was nowhere as near as deep as the Great Recession, the Great Depression, in the 30s. And that had, I don't know, depends on the data. The data wasn't as good. 25% of the people unemployed with no safety net, no Social Security, no unemployment insurance, no Medicare, no Medicaid. So you can imagine, and by the way, the country's standard of living was probably about 1/8 of what it is today. So you had a country with 1/8. There's a reason all those people are thin in those pictures, from that era. So, but imagine what would have happened during the shutdown or during the Great Financial, where we had about 10% unemployed, 10.8%, I think, unemployed. They had 25. We had unemployment insurance. We had Medicare. We had Medicaid. We were richer going in, so people had some savings. Totally different.
Factory farming, price of food was cheaper relatively to back then.
Oh, everything. Clothing. I mean, clothing, shoes, things like that today are, in real terms, just a fraction of what they were then. Why do you see all those guys, all those men mostly in the pictures with what we would call sports jackets on or suit jackets? You know why? That's the only coat they had.
That's a daily driver. You still see that in third world a lot of times. You see people wearing a suit, they come to work, they take that off, wear their scrubs, do what they have to do, and then put the suit back on. It's very common.
And so we were in a different place. So was it bad? We had 10.8%, I think was official. However, during the shutdown, so in April and May and June of 2020, we had about 23% of the workforce collecting unemployment. That was bad. That was even worse than the Great Financial Crisis, but it reverted faster. And that was because once you said, okay, maybe you can go to work and maybe you aren't going to die, and maybe, people got back to it. But it was really it was much more than the normal recession. The normal recession, if 10.8 was the unemployment rate, it would have in a normal recession gone to 7.5%, something like that. Why did it go higher? The excesses were bigger.
Got it.
That was the housing excess I was describing. We built all the houses we needed, and that's a big sector and so forth.
Got it. And just talking quickly about the COVID recession, why was it so short? Just 2 to 3 months relative to other recessions that happened?
But I think it's, why did it happen in the first place? We would have had a downturn if we hadn't shut anything down by mandate. Because you were frightened and I was frightened, and I don't know if I'd have gone to the Sixers game and et cetera. I don't know if they would have played. We weren't even given that choice. They shut it down, right? So when you shut down not only things that would have shut themselves down, but a lot of things that wouldn't have shut themselves down. And that came back pretty quickly. The thing, and in particular medical, which is 18% of the economy. Remember, you couldn't go to your doctor except for an emergency, couldn't go to the hospital except for an emergency for months. Well, come on. Not everything's an emergency. Some of the people started, that's 18% of the economy. And that was one of the big reasons. And then slowly travel, slowly this, slowly that. It went up. But I think the role of medical healthcare is understated in the comeback, because we went from full bore 18% to only go if you're delivering a baby or have an emergency, right? Wow, that's a stunning drop that happened. And then it began opening up, opening up, opening up.
Got it. Got it.
Yeah.
And on the reverse, maybe we can.
Yeah, just the last question on the recession topic. Are we currently in a recession as the yield curve is still inverted?
No, the yield curve has been a terrible predictor of recessions. In fact, almost everything is a terrible predictor of recessions. Go back to what I described are the sources, which are overexuberance, which is a hard thing to predict. And hence your AI kind of thought is if we could come up with something. And government mistakes, big government mistakes. And again, remember, people don't think they're overexuberant at the time. People don't think they're making dumb decisions. It's not like the government's sitting there going, let's make a dumb decision, right? So we are not in a recession. The yield curve is not a good predictor at all. It predicts recessions that never occurs, and it misses some that do. It missed this one. I didn't think we would have a recession. We haven't had a recession. Why? We have a lot of pent-up demand. GDP is still 2% below trend. We have a lot of making up ground, a lot of vacations we didn't take, a lot of hips that weren't replaced, a lot of cataracts that weren't removed. You guys may not have had hips and cataracts, but there was a whole bunch of people terrified to go out until the last 8 months. Still tremendous autos, huge pent-up demand for autos. Autos, think about it. First, we were afraid to go out to buy autos. Then, just as we were willing to, you couldn't get them because they didn't have components. Then, just as you were able to get them, the interest rate went up to the point where if you were borrowing, you couldn't afford it. There's a lot of pent-up demand there that will power things through.
Yes.
So I feel good. We're definitely not in a recession. We're definitely not. I don't think we get a recession this year. Why? Because we have 10 months of pent-up demand, just normal economic activity. It's not across the whole economy. We have 10 months plus normal growth. So we're not exuberant. The Fed is a bit dumb. And they're slowing the economy, but most of the economy isn't interest rate sensitive. So the pent up and normal is swamping the part that the Fed can slow with interest rates. If you don't borrow, the Fed is not slowing you, right? If you're in California, the fact that it's snowing in the Northeast is irrelevant, right? And that's kind of like a lot of the economy is not affected by short-term interest rates.
Got it. Quick thing here, as far as kind of the past recessions, you've been around for a while. You joke about it at times, but the old adage where success leaves clues. What type of investors survive the best over the recessions? Real estate investors that you're familiar with. What was it about them? What did they do? Did they zig when everybody else was zagging? The Sam Zell selling office before the 2008 crash, or buying when everybody else was selling? Who has survived the best over these long recessions?
You could try to be Sam. Sam was a dear friend of mine. You could try to be Sam. The reason Sam was a legend was it was real unusual, real unusual. Trying to duplicate real unusual, not a terribly good strategy, because you can't be real unusual, right? It's just impossible. What have I seen over the years? Lower debt survives. If you go in with lower debt, if you go in with better properties, it doesn't have to be the greatest property in the history of the world, but a well-located, well-leased property where people want to be, you'll survive better. Long-term debt rather than short-term debt. Or long-term debt rather than fixed rate long-term debt rather than floating. By the way, most of the time you win having short-term interest rate floating debt than you do having long-term, most of the time. It's when you lose that it's very painful. So pay the price have the long-term debt, you do lose, there's no doubt. You'd have been better off floating right until you get killed. And so long-term debt, less debt, and quote, better properties. And yes, cut back on your capital outlays, cut back on your appetite to do things. But remember, these are storms. These are like winter storms.
Got it. Is diversification a part of that recipe to win?
Sure.
Diversified across multiple assets? Can a multifamily investor, being astute, can they survive through all these as long as they don't have short-term variable debt, as long as they have good properties, good debt, or do they have to be diversified to survive, like kind of a S&P 500 idea of investing, the index type of investing?
If you're a passive investor, then be diversified. Yeah, because you don't know, keep your personal debt low. You don't know if you lose a job. Try to save, always save, always save. Average your portfolio, price average your portfolio. If you're an active investor, it's very difficult to say, I'm an expert in apartments in Tulsa, and now I'm going to go do a hotel in Tuscaloosa. I mean, I suppose I could diversify that way, but it's a trade-off. You're giving up your expertise for diversification. And I would say if you're a professional, exploit your expertise, but realize storms come, be prepared for the storms. So if I have a building in the Northeast, I have salt on supply, I have a snow contractor lined up, et cetera, right? Same way. If you're in an economy that does have downturns, keep your debt relatively low, lower than need be for the good years. Get yourself fixed rate debt, even though it'll hurt in the good years, and have pretty good properties so they can weather it in the sense that people want to be there.
Got it.
Awesome, Peter. Okay, Peter, let's switch the conversation and discuss inflation. So let's discuss moderate inflation at 2 to 3%, which is recommended by economists. Why is inflation at any rate good for the economy? Like, why should there even really be inflation?
So the theory, we'll put it this way, there's no good reason, but let me give you the reason given, and it's not a bad reason. Is that fair? As opposed to it's a good reason. The reason given is if we had sustained deflation, people will wait till tomorrow to buy because they believe tomorrow the prices will be lower. And if they believe the prices of everything, not one thing, not like your tech thing, but imagine they believe everything in the economy, bread, everything's going to be cheaper tomorrow than today, they'll wait. When they wait, there's no production because nobody's buying. I'm overstating it, but that's the rationale. Therefore, the rationale goes, better that they believe prices are going to be a little higher tomorrow than today, so there's a bias to do something a little bit today. Well, what that really says is we're probably doing too much today by a little bit versus ideal, right? That's the rationale. Is it brilliant? I don't think so. Does 2% just a number?
Right.
Because you could fill in 0.25%, you could fill in 1%, you could fill in 3%. I don't think you'd want to fill in 58%. That would be kind of, but it's just a number. So when people hear the Fed say this, they think it's from some sophisticated study. It's not. It's like when you tell your kids be in at midnight. Well, what's so magical about midnight versus 11:45 or 12:15? Nothing. Absolutely nothing. Is there a general concept? Yeah, don't be out when there's a lot of trouble, right? That's all you're really saying. But you have to say something specific. So they say 2%. It's kind of stupid. But it's no more stupid than telling your kid midnight. That's all it is.
Got it. Got it.
Did you do an empirical study? Did you get a lot of data about what happens at 11:45 versus 12? Of course not.
Yes. Not at this imaginary 2%. What should the Fed's funds rate be at? Like the rate that kind of starts all the rates, really.
Yeah, and by the way, the relationship between inflation and interest rates is not nearly what you're taught in a macroeconomics class. And you know that because for 8.5 years in the 2010s, the interest rate on the short end was zero. 8.5 years, it was zero. Did we have huge inflation in the 2010s? No. That should make you skeptical about how tight the relationship is. And in fact, we had inflation recently, it's gone. Inflation's long gone right now. And I can go through that if you like. Long gone right now. We have minor deflation.
That's our next question right here, actually.
I was gonna say, Peter, where are we at today? Like, how is inflation measured, and why do we believe?
All right, so they collect about 130, the prices of about 138,000 items each month, and compare them to what the price was last month versus the month before. And they don't take into account coupons if you're buying your things with coupons or Super Saver Tuesday, but they do a legitimate job. Okay?
And when you say they, you're talking about the Federal Reserve and
no, Bureau of Labor Statistics.
Bureau
of Labor Statistics. Okay. And by the way, they've been doing this a long time. Do they do a perfect job? No. Trust me, they do a lot better than the three of us could do if we started from scratch, because they've done it a long time. And by the way, let's take the CPI report that just came out on Tuesday. Got a lot of headline, 3%, 3.5%, blah, blah, blah. Okay, I went and calculated. By the way, I just went to the data and got my calculator and calculated. And the inflation rate from August 2023 through January 2024, the data that just came out, annualized. So if you take the inflation that occurs and just make it annual rather than over those months, was 1.1%. It's not my data. That's the data that was released on Monday. Since August, annualized, we have 1.1% inflation. Now, the main driver of that inflation was housing, shelter. And they had shelter, which is 40% of that index, 40% at 6%, 5.9% to be precise, okay? Now, by the way, 40% of the index at 6% is 2.4 percentage points of inflation, right there, right? You don't even care what the other 138,000 prices are doing, okay? And even with that 40% of the index, okay, being 5.9%, it was only 1.1% annualized since August, okay? Now, one thing people don't know is they do the price of your tie. That's one of the 138,000. They did that, what it was last month versus a month before. For housing, they go back 8 months and ask what it was 9 months earlier. Okay?
We had a boom because of COVID.
You'd be in everything. So suppose they'd go back and take the price of all 138,000 items 8 months ago versus 9 months ago. You think inflation would be a lot higher? Of course. Because what happened was we shut the economy down, demand came back across the economy, shortages of everything, prices of everything went up, profits of everything went up, supply came online for everything, including housing, apartments, and guess what happened? Prices came down. Now, I'm in the business. And by the way, all you have to do is call Graystar, which has, 700,000 apartments, or Portland, which has 100,000. Look at Equity Residential, what's it, 52,000, et cetera. And you know what real inflation for apartments was over that time period? Basically zero.
Wow.
If you go back to January, March, April, May of 2023, it was 5, 6, 7% a year. But that supply pipeline came on, just like it did for every other item in the economy. And as supply came on, even though demand was good, prices moderated. Supply and demand met. And in some cases, supply overshot, had prices falling, and some they didn't quite catch up, it rose. Now, if you take out housing and set it at zero, which is basically what it really was, and if you don't believe me, call any of the apartment operators and ask them what they got. If you put it at zero, the inflation rate since August was -1%. Wow. Annualized. -1%. This is not fancy math. This is that data. And the only change I made was I called people who actually have apartments and put in their answer rather than 8 months ago data for housing. Now, the week before that, personal consumption expenditure data came out, different index. It only has a 20% weight for housing. So other items have bigger weights. That's basically all it amounts to. And it was in the fourth quarter. I just did the fourth quarter, 0.4% inflation annualized. 0.4% inflation annualized. That includes housing going up at 5.8% because they're going back 8 months earlier. If you put housing in at zero, the personal consumption expenditure inflation is -0.7%, call it 1%. We are living right now, forget a year ago, forget 8 months ago, right now. You don't ask somebody, what speed were you going 8 months ago to know what speed they're going now? You don't ask them, how much slower are you going today than a year ago? You ask a real simple question. What speed are you going right now? And right now, inflation is going at basically zero across the economy, maybe slightly negative.
Got it. And if that's a lever that the Fed pulls, which is interest rates, and they've pulled it too far, they pulled it too far. Isn't that then the logic says we're not going to have a soft landing if it's sitting at 5.25, 5.5, and inflation is at zero or even negative? Isn't that too much to pull? And doesn't that kind of cause a recession?
It's a crazy high interest rate that affects about 20% of the economy and has no effect on 80%. If you were to have a heart attack right now, you're not going to say, nope, don't send me to the hospital. Wait till Powell cuts the interest rate to 4%. Or somebody who's listening, who's about to have a baby, isn't going, no, I'm not going to deliver until Powell lowers the interest rate. So medical is basically immune to interest rates, and government basically immune to interest rate. By the way, we're not saying we're not going to do defense because of, we're not going to stop building a bridge because the interest. So about 80%, when you go through it, is immune. 20% is. So 20% is being punished and is being slowed down. And 80% is going, I don't know. I don't know what they're talking about, really, right? Mm-hmm. And they are not slowing the economy. They're slowing a small part of the economy. It's like trying to stop a car by just putting on one brake or something, right? Or, it's not going to do it.
Got it.
Makes sense.
And by the way, the inflation did not occur because of the Fed. It did not disappear because of the Fed. It occurred because of supply shortages. That's why it happened so fast. Normally, if it was driven by the Fed, it would slowly roll up like we had in the 70s. This didn't roll up slow. You woke up on Tuesday and it was happening. And that's because you started spending. And once you started spending and there was nothing there, prices went up really fast. Almost for everything.
Got it.
And it came down really fast because over the last 14 months, supply came online for everything.
Yes.
And again, so the Fed has got the interest rates way too high. They're punishing 20% of the economy that doesn't need to be punished. And in fact, remember, when you talk about crash landing, that verbiage is we're overheated And can we come down to sustainable? We're underheated. We're 2% below normal. We need to get the economy even going further. So the Fed has the rate too high. Most people are immune, but not everybody.
Fair enough. Talking about immune, the Fed itself has a debt, and it's not immune to those interest rates. So, I mean, we were looking at this government debt, the next conversation we want to have with you, and most governments around the world have it. And interesting enough, some governments were able to reduce their debt to GDP ratio over time. But talk to us about the U.S. government debt and the $32 trillion with a T, and
Okay.
give us your thesis on that.
So I think this is unbelievably simple. We have a GDP, first of all, just so people know, of about 28 trillion. So our income, if you will, loosely defined as 28 trillion, okay? Let's take your 32 trillion number, which is about right, the headline number. Could you pay off your home mortgage with 9 months of work? We could pay off the federal debt by just giving all of our income for the next 9 months to pay off the debt. I'm not saying we do that. It's like you're not going to pay off your mortgage by taking 100% of what you owe. But typically people have mortgages about 5 times their income. We have debt that's about 120% of our income, 1.2 times. So if our homes are affordable, our debt's certainly affordable. Just to start there. Just in normal debt metrics. Now, the second part is, of the 32 trillion, about 15 trillion and 16 trillion is owed by one branch of the government to another branch of the government. Okay? So your left pocket owes your right pocket. If you took the money that your left pocket owes to your right pocket, and you took it out and gave it to them, one branch of the government would have less money, the other branch would have an exactly offsetting amount of money, net, no change. You would agree? So we pay it off and have no different burden. Another way is to think about a payment. One branch of the government is paying interest, the other branch is receiving it, it's a net wash. When you net that out, we have about 17 trillion. Okay, now that's still a big number, but remember 28 trillion is GDP. So I made it a lot more manageable simply by pointing out money that we owe to ourselves, when we pay it, we also get it. Okay, so
Got it.
we get the.
But Peter,
So
let me kind of break this down though, because you are on our side, right? The Fed is there; they're in somewhat involved with the government. Jerome Powell has much more of a dog in the race to minimize this debt number. Whereas I'll read you his quote, and basically what he says: in the long run, the U.S. federal government is on a unsustainable fiscal path. The debt is growing faster than the economy. We're borrowing from the future generations. I would have imagined you saying this term and him minimizing it, but it's on the reverse, and that's super confusing to us.
One of us is smarter than the other? I'm joking. People can decide which. Look, is debt growing a bit faster than the economy? Yeah. Is that mathematically sustainable? I mean, it doesn't take a math genius to say eventually that doesn't work. Imagine you have $1 of debt, okay? And whatever your income is your income, and you have $1 of debt. And then the next day you have $2 of debt. Is it still manageable, even though it's double? You now take it to $3. Even though you increased it, is it still manageable, given your income, $3 a debt? Yeah. How about $4? Still manageable. By the way, could you do that to eternity? Probably not. You're not trying to do it to eternity. Things adjust. So it's kind of mathematically accurate, but kind of intellectually vacant.
So why do some people say we've gone beyond the point of return when it comes to the U.S. debt? And some people's thesis is we can never, and some people are even talking about not paying the Chinese back.
Because they get quoted. You don't get quoted by saying, come on, we could pay off our debt in 9 months if we really wanted to. The government owes themselves isn't real debt. You don't get quoted for that. We'll put it differently. Negativity bias. You guys are, I'm sure, well aware of negativity bias, and apparently people believe it's hardwired into us because, gee, if a lion's coming, I better be highly alert to it, has been innately kind of, evolutionary into us. So we're very aware of negative. You get headlines, you get quoted by saying we've hit a point of no return. But when you look at it, people have been saying that my entire adult life. Literally, they've been saying that my entire adult life. And here we are. And by the way, the economy is bigger. The economy is stronger. We have higher standards of living. Did we waste some money on what we spent the government money on? I'm sure. But by the way, we wasted money on some of the private things we spent on. Could we have had a bigger economy today had we not wasted money buying heroin? I'm sure. I'm sure. Could we have had a bigger, stronger economy if we hadn't done some dumb government spending? I'm sure. That's not, the point is whether it's a debt or not, whether you borrowed or not, spending on heroin is not productive. Whether you borrowed or not, building a bridge from nowhere to nowhere is not productive. Those are the real questions. We're rich. It's just we as a country. If we were Botswana, it's Zimbabwe, very different issue. Poor people don't have the luxury of doing stupid things.
It's more than that, though. It's more than it's having 5,000 nuclear weapons with intercontinental ballistic missiles. It's having hundreds of bases around the world. It's having your money as the main money trading around the world. We'll get into that in a moment. Let me ask you, because we're a bit short on time here. So let me ask you a couple other questions. So a lot of gurus out there, Dave Ramsey's, talk about debt, particularly for people that for their primary residence. His thesis is pay off your debt the fastest way you can. This is for their main home. And over the years, in my experience, the last 20 years of being in business, I've seen people have built most wealth by owning their main home. And that's how people have either other generations. What is your thesis on paying off your debt on your primary residence? Is debt a good thing for people? Should they borrow if they can financially afford it and buy rental properties? What's your concept on, or should they even should they even get into buying a home with debt, or should it be bought cash? Like some of these crazy things that I hear, in my opinion.
So I haven't had a mortgage for 25 years, 30 years, okay, on my home. Why? I think I have more productive things to do with my money. And I don't want to invest that. I don't view my home as an asset. I view it as a place I live. And if it turns out to be an asset, God bless. I'm not religious, but God bless, that's a bonus. But what I really got was to live in it. I've lived in my current residence 33 years. So until I sell it, I don't care if it's up or down. I'm living in it and enjoying it. That's how I think people should approach their homes. Now, not everybody has the luxury of being able to buy their home debt-free. And so then borrow. I'm not telling people not to borrow. I just think that you are pretty exposed. You're right. People have made money on it over time. But if they'd have taken their money and done stocks, they would have made money on it too, right? I mean, look at the stock market over 33 years I've owned this residence. I owned another before it. The stock market did pretty well over those 33 years too, right?
7% compounded approximately, I would say.
I did okay, right? And so I got to live in my home. Right. I got to live where I wanted to live. I don't have children that way, but I got to raise a family. That's, to me, I get it. It's a financial asset and so forth. The minute you start thinking about it as a financial asset, you're going to get in trouble. Think about it as where I want to raise my family, and can I afford it? including borrowing. So I'm not against borrowing. That's not the point. I have the luxury, I can live where I want to live without borrowing.
Got it. Because prior to coming to the US, we lived in Canada. In Canada, the maximum mortgage term you can get is 5 years. The US is 30 years. And I think people who lock in their mortgages at sub 5% for 30 years, in some cases sub 2%, is literally a lottery ticket. So that's what that conversation came up. But moving on here, also I want to talk about, since World War II, the US has been the world's #1 superpower. It has the strongest military by leaps and bounds. The US dollar is the dominant world, economic kind of dollar that's being used around the world. And science and advancements have been brewed here in the US more than anywhere else, but it also has its caveats. So, the retiring baby boomer generation, reduction in population growth, not including immigration, illegal immigration, never ending wars around the world, so on and so forth, right? Positive and the negatives the US has. But with the emergence of growth of China in the global economy, is the US still the best place to invest? Are you still long-term bullish? And the reason I ask that is really what China has done from the 80s to today. 750 million people living below the poverty line in the 80s. We have a family friend who traveled to China in the 80s, and they said at the airport, they were actually holding on to a candle light instead of an actual light, telling the planes which way to go. That's how archaic they were. But now they have less than 10 million people living below the poverty line. And some scholars say that this is one of the greatest achievements of humankind, what China was able to do. Is that keep you up at night? Is there any concerns about US possibly not being the best place to invest long-term? Tell us your China, US.
So the answer is no. However, I'm not a military expert, so the military part of it, I don't have an opinion on, if there were a military thing. Put aside the military.
And they're not. And Chinese supposedly, as far as kind of inherently, they're not a fighting, adventurous type. They're very risk averse. They rather do business than go to war. But go ahead, keep going. That takes the military aspect out of it.
I was going to say, tell that to the Tibetans. Look, economically, I was in China the first time in 1986. It remains, and I've been in 86 countries in all 7 continents. Wow. It remains the poorest place I've ever seen in my life. And that was in 86. So I can only imagine the closer you get to the Cultural Revolution and all that, before it was even poorer, right? And I've been to a lot of really poor places. Second, the striking thing about China's growth in the really last 30 years, really since Deng Xiaoping, right? The striking thing is not how far they came. The striking thing is how far they had not come since 1900 to Deng Xiaoping. Basically, life was the same or worse when Deng Xiaoping takes power versus 1900. That was hard to find anywhere else in the developed world.
They were addicted to opium. I mean, it was Mao that came in and made that, said a bullet in the head, other than, smoking opium. It was a totally different world.
So and by the way, it's very impressive. I'm not taking away. Everybody talks about all the roads they built, all the buildings they built. We built some of those roads in 1910. We built some of those roads in 1920. We built some of those roads in 1930, 1950, 1970, 1980, 1990. The reason they had to build all those roads is they had built no roads. They had no train system that worked. They had no airports. You just gave it, right? They had no airport. I remember the Beijing airport. It was like a bad American Legion lodge. It was awful. The reason they built it all is they had built nothing all those years. You got to give them credit for what they've done. I'm not taking away. Now, put the reality on it. Do you realize that every year, including last year, the absolute level of income of the median household in the United States rose by more dollars than it did in China? Okay? More dollars. China grew faster. Why? They were poorer. But in absolute dollars, and you can't spend percentages. You can only spend dollars. We got richer every year than they got, even though their growth rate was much faster. And as I say to people, would you rather have my income growing at a pretty good rate or Elon Musk not growing at a very good rate? Well, that's obvious, right? That's the US versus China. Great that they're growing. Great that they're growing. But, they're growing twice as fast as us right now, and they have 4 times the population. Right? You do the math. Half as fast, 4 times the population. The median income is $16,000 a household. Ours is $68,000. Do 2.5% times 68,000 versus 5% of 16,000. And you'll realize in absolute dollars, we're growing faster. Not good or bad, just do the math, right?
Yes.
Now, am I afraid of them? No. I hope they keep growing.
That's the question. Or is China a friend or a foe? Is it a partner? And we have a few other questions. We hope to get them as well. So
the answer is yes. It's a friend and it's a foe. So is Germany. Germany is a friend and a foe. If you're
we have a military base. We have a military base in Germany. They're restricted from doing certain things. China, we don't. So
yeah, but I mean, do you think if you're General Motors, is Germany a friend or a foe? Well, they have Volkswagen, right? If you want to go on holiday, they're definitely a friend. I mean, all these countries have dimensions of friends and foe, right? Some political, some economic. Of course, they're friends and foes, depending on. China is still trying to figure out its political system, and they've morphed in, they're continuing to morph.
Well, they're a dictatorship, capitalist kind of mixture, which is very unique to the world, kind of the way the governments run.
Well, it's not even capitalist. They still have like 60% of the economy are state-owned enterprises and so forth. It's an odd combination. I agree. But economically, we're massively larger. I mean, people don't understand. We're a quarter, roughly, of the world's GDP. But if you said the world's discretionary GDP, right? Discretionary, not just survival, we're probably 40% of the GDP of the world. I mean, it's stunning. So people say, well, will somebody replace the dollar? You have to have something to replace it with. So I'm reminded, in many ways, I'll be 73 next month. And trust me, I'm not what I was when I was 25 or 22 or whatever, right? However, compared to 72-year-olds, 73-year-olds, I'm much better off than I was at that age, right?
It's all relative.
Yeah.
It's all relative.
It's all relative.
Peter,
We are so far ahead. What other capital market? By the way, did we have Madoff? Of course. Shameful, disgraceful. Do we have scams? Of course, disgraceful. They're regular in these other countries. I mean, just think of what China did.
And they get executed, not just imprisoned.
And just think of what he did to Jack Ma. I don't know Jack Ma. That wouldn't have happened here. It just wouldn't have happened. Can the government hurt your business here? Of course. Will you get an absolute fair trial? Probably not.
But Peter, in some cases, when you have a dictatorial type of government, they can actually set certain rules and make things move faster in a weird way. Like we were talking about opium pandemic that they had, and how they came in and it was a bullet in the head, or smoking opium, and they changed. Everybody cut their hair short. Chinese used to have opium dens and long hair. I mean, in some ways, having a level of control like that, you can push the economy, you can push the people in a weird way. Just saying that's.
Yeah, the history. It's interesting. I'm doing a session with the children we support in Kenya on Sunday, a Zoom session on Joseph Stalin. Probably no one ever had more absolute control of a large economy than he did, and he certainly pushed it. I'm not sure you would say, and he had the power to push it. I'm not sure you'd say it was to the good.
No, you
And
picked the evilest one of them all. I mean, 28 million Russians died, and only 12 million of them were military men in World War II. But here, let's move on because we know we have to run. I was just trying to get a couple.
Just a couple
Our
more.
main show was your predictions for 2024, so we really want to,
Yeah,
and beyond. We really want to get those
Yeah,
in.
so Peter, let's look into the future as far as rates and the economy. Okay, so what are your predictions for 2024 as far as rates?
so in terms of long rate, I think it will, by the end of the year, steady out at something 3.7, 3.5. Why? Because it's going to become clear that inflation is going to steady out at some number like 1.5%, just like it was before the pandemic. And it's going to be the same because we'll get back to situations kind of like it was before the pandemic. So the long rate will steady out somewhat there. When I say steady, bouncing around that from there. And then I would say the short rate, the Fed's going to be slow. The rate should already probably be 3.5%, given the inflation numbers I was describing, should be massively lower. They're going to be very slow. Unfortunately, they're going to be very slow. They're going to punish that 20%. Essentially, there's this old phrase, the beatings will continue until morale improves. That's the Fed's philosophy. The beatings are going to continue until morale improves. They're having no effect notable on inflation, but they sure are hurting a lot of parts of the economy needlessly.
Got it. Another quick question for you here. Over the next 10 years, what's the asset class you feel most bullish about? We know that industrial and multifamily are the top runners, but what is your belief on that?
If I had to say you're going to put all your money in one asset class, which I'd never say, right, to most investors, I'd probably pick multifamily. Why? It's not going to get disintermediated. It tends to keep supply under relatively good control because not the high-rise stuff, but the suburban stuff is easy to stop when it starts getting overbuilt. And no one tenant can blow a hole in your income, which can happen. By the way, warehouses also can get shut down pretty quickly in supply. And I don't think boxes get disintermediated. Maybe they do, but I don't think so.
Because also technology affects industrial, where you can have drones or other things, whereas somebody needs a roof over their head. The technology can't create roofs over heads.
That's what I mean by the disintermediation. I think and the other thing about multifamily is no single tenant can blow a hole in your income. You can have a great industrial, and if one company goes bankrupt in an otherwise strong economy, imagine even in the strongest economies, some companies go bankrupt. Now you have 50% of your building empty and you got to backfill it and so forth. There's no way an apartment building goes from 94% occupied to 50% occupied. It might go to 90, might even go to 88, right? It just can't because of the reality of the situation. So I like that part about it.
Amazing.
And that would be, but I'd say I wouldn't recommend to put it all in one, but if I had, and I'm living that, I'm putting most of my marginal money in, my direct active money in apartments.
Yes, I think we've seen some emails coming through. Audience question. Question on distress and his opinion on the chances that banks will take back properties or if there will be more loan modifications and workouts.
Lots of modifications, lots of workouts. The biggest sector that's got problem is office. And the last thing most lenders want is an office building. If you can't operate the office building, how the hell am I going to operate it? I'm going to take it from you and sell it to somebody just like you, but it's going to take fees and 8 months to do it and lawyers to do it. And I have no better operator. And the only way somebody else is going to buy it is if I lend to them to buy it. So if you've got a bad borrower, yeah, maybe. If it's hopeless as an office building, maybe the borrower you're going to get lots of modifications.
Especially on development deals where the developer knows what they're doing, but they're just short on cash. You're not gonna bring another developer to build something mid construction. So Hey, we really appreciate your time, your wisdom and knowledge. Really appreciate you came on here. We went a bit over time. We really forgive us, but we want to bring you back again next year. So we wanted to make sure that.
We would love that.
Just quickly, just maybe you can verbally say if people want to subscribe to you in some way. You can say it verbally, so it's on our audio if you don't
What's
mind.
the best way they can reach you?
Sure, everything, you can reach us by going to Linneman Associates, Linnman Associates website. You'll see everything we do. You'll see talks I've given. We probably would post something like this when it's available. We post that there, about Linneman letters there, about speeches I'm giving and so forth is there. Information about our charity is there. That's one thing I do.
Amazing.
Amazing, Peter. Thank you so much for your time.
Thank you for having me.
Thank you for joining us for this episode. We hope this conversation enlightened you on how to win big in this highly profitable and risk-averse space. Get on your feet and embrace this world that offers so many opportunities just waiting for you out there. Continue your journey to becoming a savvy real estate expert by subscribing to the show at cpicapital.ca. Don't forget to leave a positive rating and share with your friends. See you on the next one.